Hello, everyone, and welcome to the ECB interest rate decision live trading webinar hosted by Swap Hunter. I am Christopher Smeelo, head of sales at swaphunter.com. I've been a professional trader and portfolio manager for over 10 years now. I also now focus on training and educating other traders and investors so they can avoid the same sort of mistakes I made when I was starting out. Believe me when I say the learning curve when trading in the financial industry for the first time is pretty steep. So, even after several years' experience, you begin to realize that you're always going to be learning and having to adapt to new market conditions. My goal is to speed up the learning process for people who want to trade the markets. And today, I'm going to allow you to watch how I will trade today's crucial interest rate decision coming out of the European Central Bank. We're going to cover several topics. Firstly, how interest rates cuts can affect currencies and indices. Market anticipation of the ECB rate cut using fundamental analysis, then technical analysis of euro dollar and the DAX. We're also going to look at how I will prepare the trades in order to capitalize on this event, this live event. And we'll cover risk management and how to manage the exposure of your equity as best as you possibly can on such a major event, which is going to create a lot of volatility. So then we'll go into the live trading session on MT4, that's MetaTrader 4. Then we'll have a look at how well we did, or if we got it wrong. Of course, there's no guarantee that we're going to make a success out of this event. So let's go on. I obviously have to mention, as part of compliance and regulations, that there are risks associated with Forex trading. I'm not going to read the whole slide here. It's just very important for you to know that can't just start trading Forex without some coaching, some training, some education, which is what we provide at Swap Hunter, and it's what I do on a daily basis for our clients. Okay, so interest rate cuts. Um, the European Central Bank are currently they're holding their interest rate at 0%, and it has been at zero for quite a while now. It's a monetary policy used by central banks to control the value of their currency to manage inflation and deflation in order to react to inflationary or inflationary environment. So their main objective at the ECB is price stability, and they're aiming to achieve a level of inflation, a maximum level of inflation of 2% for the entire eurozone. Today, if there is a rate cut, which many economists and many sort of news pundits out there and traders and investors are expecting, probabilities are very high, um, that they will cut rates today. Me myself, I'm not 100% convinced that Mario Draghi will cut rates today. It's his last meeting for the ECB before he exits the ECB as president, and there will be a new president. But if there is a rate cut today in the next, 15 minutes, the data is coming out, you can expect the euro to fall against the dollar and other sort of G10 currencies. Now, you can see from the chart here that we have a couple of or a few different types of interest rates. Okay, main refinancing rate, which is just the general interest rate that most of you are aware of. This is the interest rate that you will receive from your bank by parking money in your savings account. Okay, then we have a deposit rate, which is more to do with interbank It's more to do with how much the ECB will charge or pay um, financial institutions to park their money in the ECB. All right. So you can see also from the chart that most people are looking for, a 0.5% uh, uh, rate cut. Now, like I said, I'm a little bit skeptical of whether or not they're going to cut rates today, because it is Draghi's last meeting. Of course, he could want to go out with a bang, and it is needed in terms of what the market wants. Okay, so like I said, if there is a rate cut today, you should expect the euro to fall against the euro dollar. We're going to be focusing on the euro dollar and the DAX mainly. Okay, I'll explain why. Now, if there is this cut, then euro dollar should fall. Now, what will happen if the euro dollar falls? Okay, will it be good for the eurozone and the DAX and the Euro stocks index and the CAC and all the other European indices or European stock markets? Essentially, the rule is yes. Okay, so it helps nations who rely heavily on exporting goods, like Germany, mainly automobiles and cars. That's their main sort of industry in Germany, and that's their main export. So by making the euro cheaper, it makes it easier for foreign nations to buy those goods as the exchange rate declines. So if we're looking at U.S. importers of German cars, a cheaper euro is good against a stronger dollar because they can afford to buy more cars at a cheaper price. So the idea is essentially the cheaper currency, more local goods can be sold at a cheaper price, boosts companies' share values, and then stock markets should rise. Okay, that's the rule. Um, it's also, it means that it's easier to loan money out to big corporations in order for them to do more share buybacks, which there's been a lot of this going on since 2008, uh, and this is something that Wall Street loves these days. They like cheap money sloshing around, cheap fiat currencies sloshing around in the industry, in the markets, so that they can do these share buybacks. Now, many economists, news forecasters, and myself consider this an artificial economy or an artificial market, as the rise in share prices from share buybacks is not based on sales or productivity. So to summarize, that there's a correlation between low interest rates, cheaper currency, and higher stock markets. Now we're going to move on to what seems to be the anticipation from the markets, from investors and traders, by looking at the charts in a little while. But we're just going to cover some fundamental analysis, which is kind of putting pressure on the ECB to cut rates. In my opinion, and in many other people's opinions, many other economists' opinions, they should have raised rates back in December in order for them to have had more room to 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 cut today. But that's not the case. So, and if you've been looking at the stock markets over the past week, you've seen quite a risk on rally, okay, which means that they've been rising. There's a bull rally going on for the past week or two, which shows you that the markets are anticipating very strongly a high probability that there will be a rate cut today. All right, it's due to a number of reasons, and um, I will expand on that. It's not news that the global economy is slowing down. We can see this in the latest declines, in the latest PMI exports and GDP data releases coming out of China, Germany, and the United States. So this is a direct effect of the US-China trade war and the tariffs being imposed by one another. I have to point out that US Germany and China, they are extremely close trade partners. Now, if you imagine all of the car factories and auto factories, manufacturing factories out in Germany, where do they get all of their steel from and their metals? They import a lot of metals and other goods from China. Okay, there's a massive sort of trade deficit with China and Germany. Um, because of the trade war and the tariffs, and the taxes and the tariffs and the prices of the goods coming out of China, like steel and iron and copper and other commodities, soft commodities or metals. Germany have been caught in the middle of this trade war, and Germany has been the engine of commerce in the EU since its inception. So one could also speculate. This is, this is due to the fact that we're very close to the end of this economic cycle, which I might add has been the longest, the slowest recovery from any major recession in history. Central banks, for the most part, have reached their limit when it comes to quantitative easing or QE, which is essentially just money printing. So, cutting interest rates seems to be the only tool left in the toolbox, even though Mario Draghi has suggested that he will provide a new stimulus package today, along with the potential rate cut. So, stimulus is very much desired and very much wanted by the markets due to the trade war and the global economic slowdown. The Federal Reserve still have room to cut rates much more than many other developed nations. Their interest rate is at 2.25%. That's 2.25%. New Zealand very recently cut their interest rate down to 1% in order to free up more cheap money to boost their market. Today we'll see what the ECB will do. The big difference here is that European interest rates are at 0% right now. But if they cut today, it will mean going into negative territory, which means that you're going to be charged to park your money in European banks. Okay, which is it's unprecedented. It's a new form of monetary policy, and we will see where they go today. Like I said, I'm a little bit skeptical that they're going to cut rates today, being that it's Mario Draghi's last ECB meeting. Although, like I said, he might want to go out with a bang and do everything it takes. It's common knowledge to everybody who follows economic news that Donald Trump is putting a lot of pressure on the Federal Reserve to cut rates much faster and more aggressively than they forecasted in order to compete with China's economy because of their cheap currency, the renminbi or yuan. Now, Donald Trump wants them to cut by 50 basis points or half a percent on the next Fed meeting. So there's also been many accusations from Donald Trump that not just Donald Trump. I mean, it's also been around and been on the cards that China do manipulate their currency in order to keep it very low, in order to keep their exports very cheap, in order to stimulate their currency and I mean their market. Okay, to make it cheaper for people to import their goods. So it looks like Trump wants to play them at their own game. And this has led to speculation, as far out as it sounds, that the US dollar could fall dramatically over the next few quarters, financial quarters, that is, and that it may no longer remain the global reserve currency. It could be replaced by something like a decentralized digital currency, something similar to Bitcoin or Ripple or something like that. And this is not my opinion, although I have considered it. This was actually suggested by Mark Carney, the governor of the Bank of England, at the Jackson Hole Symposium last month. And it's also an opinion shared by many other economists or sort of cryptocurrency traders. So we're going to go on and move on very quickly because the data is coming out in a few moments, in about 6 or 7 minutes. We're going to go into MetaTrader 4 and have a look at the charts. Okay. So as you can see here, we have the euro dollar, a 1 hour chart. Goes out. Balance of near enough 21,000 euros or US dollars. And you can almost see that the correlation here with euro dollar getting cheaper and the DAX gaining, based on the fact that the euro dollar has taken some major knocks over the past couple of days. Okay, yesterday especially quite a drop from 110.55 down to 109.88, right? So I'm going to look at different chart time frames. Okay, so we're going to go slightly longer term here, both charts. I'm going to maximize the euro dollar. Let's focus on the euro dollar. Now, see, it's been in a constant decline since beginning of the year, and even longer. Go onto a week chart. See, it's been just down, down, down. One directional trend with obviously some zigzags and some some rallies here, some bullish rallies, but generally, I mean, if we're looking from 2011 even, where it was probably at one of its highest rates, we can now see that it's down considerably, down to 110. Now there was during this period from 2014, 2016, all the way through to today, that a parity trade, what we call a parity trade, meaning that it will come as cheap as the dollar. Okay, it will reach equal or equivalent value the dollar, which is called parity trade. So they will be equal. They will reach an equal value. Now we got as low as 105, 104, but it never quite broke down any lower than that. But of course, I mean, we are looking at a major event today, and it could if there is an interest rate cut, depending on how much they cut by, it is 0.5%. That would be a bit of a shocker for the markets. And if Draghi does also introduce more stimulus, more quantitative easing, more bond buying, more bond purchases, whatnot, then the euro dollar will go down even further, and we could be looking at that parity trade. So let's have a quick look at the DAX as well. Still on a daily chart here. You can see over the past 12 days. It's a 12-day rally. It's been very good. Sort of, it's been a good run for the DAX over the past fortnight or so, the past 10, 12 trading days. But we can also see here that we've reached quite a strong uh, resistance level. And what seems to be forming here is a head and shoulders pattern. See one shoulder, neck, the head here, another neck, shoulder. So this is a very typical technical um, price formation, or price pattern, which from a purely technical level would be, in my opinion, a very good time to start selling the DAX after a 12-day rally, a 13-day rally. It looks like it could be overbought, and it's reached this very strong resistance level here at 12,400 roughly. So I would say 12,500 is most definitely, on the cards. It's a very strong possibility today. If if they do cut rates, like I said, euro dollar should go down, and correlation between euro and DAX would mean cheaper European stocks to buy, and that would mean um, DAX should rally again. However, this is a fundamental live event trade. We are going to focus on the technicals, and this is what we're doing right now. But of course, the main event is a fundamental piece of data, which is coming out in just a couple of minutes. So we're gonna put a couple of technical indicators very quickly. We're going to throw relative strength index on both assets. All right, shows us overbought and oversold positions, pricing. So we're just going to stick very simply to support and resistance levels, and and relative strength indexes. We're going to remain on a daily chart. However, when the data does come out in just under 1 minute, we are going to see some extreme volatility, I would imagine, on the market. So what I'm going to do is try and anticipate that there will be an interest rate cut. This is what the main general consensus is. So what I'm going to do now is go for a sell on euro dollar and a buy on the DAX. This is the general, uh, sort of trade. This is what everybody is looking for, and this is what everybody is anticipating, and this is what has been priced into the markets. The reason I'm using zero point 0.1 mini lots on either side here is because this is a $21,000 account, and to place a full lot would be far too risky on this trade. Now you can see the data has come out. Let's see what it is. Okay, so deposit rate is out, which is just between banks. The ECB interest rate decision is still the same. Okay, so they've maintained the interest rate decision. They've maintained the rate. They haven't cut. So now what do? We react to the data. What I would suggest in this situation is that we're going the wrong way. So I'm going to take this. I'm going to take this loss. All right, based on the fact that they've held interest rates. I'm now going to go the other way. All right, this is not good for European markets. I'm going to sell the DAX, buy the euro dollar. Okay, the fact that they've held interest rates doesn't mean that this will boost the euro 300 pips or to any major highs, okay, or any major new high levels. But what it does show is that they're not ready to cut rates yet, or to follow the Fed cutting rates. Okay, so this is what generally what we get on event trading, and I'm not a massive fan of it because you do get these knee-jerk reactions. Okay, now what I mean by that is you'll find the data release will come out, and everybody's anticipating one thing or another. It's essentially a 50-50 outcome. Okay, so a lot of people have been anticipating that the rate cut will come in, and it hasn't. Okay, they haven't cut rates for a long, long time now. Okay, long, long time they haven't cut rates. It's been at 0% for a long time, which is why I was skeptical at the beginning of this video that I didn't think that they were going to cut rates, and they haven't. Now we should see some declines on the DAX based on the fact that RSI is at 70. We've had a 13 or 14-day rally, okay, to the upside. Euro dollar is continuing to decline. Now, normally I would also have Bloomberg or CNBC live news on as well, but I can't have that sort of playing right now. But I will have a look at some of the, if there are any news releases or big news points here, big headlines, trade on. Okay, so gold will be climbing, right? Okay, so there's no major headlines out yet. Fresh. It met the forecast. That's the deposit rate. And when you're doing live event trading, this is what you're using the um, economic calendar. Look at the previous data, which was 0% in the interest rate decision. The predicted rate, or the predicted change, was 0%. So, okay, there are a lot of people expecting a rate cut today, but there were just as many people expecting them not to cut rates, probably based on the fact that Draghi's just on his way out. I don't think he wants to rock the boat too much, and no, not on his last meeting. He might be wrong. It could be the wrong thing to do, to cut rates right now for the Eurozone. So we've got these trades now. Obviously, we're not doing fantastic at the moment. But like I said, there are always knee-jerk reactions based on live event trading. Okay, so event trading it's always, you're always going to see huge volatility, right? So let's expand on the euro dollar. Look on a 1 hour chart. We had this knee-jerk reaction based on the expectancy of a rate cut. come down from 110.50, 60 pips to 109.90. Now this looks like a very soft support level here. 109.80. See how investors, traders digest the information, see how they react to well, essentially a non-event. Okay, so there was a slight cut in the deposit rate, which is, like I said, between banks. It's the interest rate that is applied to overnight deposits from institutional financial institutions into the ECB, right? So there was a zero point 0.1 cut. That, but the main event really was the refinancing rate, the main interest rate decision. Okay, of course, we also have the CPI data coming out later today, and in about 40 minutes, that is, and also the monetary policy statement press conference from Mario Draghi. So I this these this press conference, traders hang on every single word Mario Draghi says. If he's hawkish, which means bullish or positive, then you will see a massive reversal on the euro dollar. Okay, you'll see the euro dollar climb at depending on how positive he is about the economy. But let's face it, we all know that there is a global economic slowdown, and Germany are in a technical recession. So Germany being the sort of powerhouse of the EU, this is probably not good for the DAX or the euro dollar, even though there is a correlation, but it's not a hard and fast rule. Okay? It's not 100% guaranteed, and they can both go up and they can both go down. But I think what we're seeing here is the correlation in effect. Okay, so the euro dollar is continuing to decline. What I'm going to do is wait this out, because the rate cut was not in. There was no rate cut, so we could see this price on the euro dollar reverse very, very soon. Now, again, we're going to set up some support and resistance levels here. And this, when it comes to support levels on the euro dollar, it's very hard to find them, because it has just been in a consistent downtrend for a very long time now. However, we could see it hit this bottom level here. Price 109.23, 109.25. Could see another 40 pips the downside. 109 we could reach. Then, because of there's no rate cut today. What I believe is that the euro dollar will reverse. What I'm going to do is try and get back in euro dollar buy trade. In fact, there was no rate cut. I'm also going to try and catch the downside reversal on the DAX. Go to a strong support level here, set up a level 7,500. Very unlikely that the DAX is going to drop by 800 points. However, anything is possible. Forex, anything is possible. So see that it's a strong, very strong support. Might not reach that 11,500 mark today, but I'm quite confident that, given the fact that, as I mentioned earlier, Germany are in a technical recession right now, based on their latest manufacturing data, the latest PMIs, their GDP, their export data, it's all been declining for a few months now. So I'm going to wait this out. I still like my trade. I'm still confident, even though we're in a minus right now, a floating profit and loss of $195, let's say. What I'm going to do here is place a buy limit 109. I'm going to go for 109.60. In fact, I'm going to go a little bit lower because I think this knee-jerk reaction. Now, you have to understand as well that with event trading, what market makers do now, market makers being the large financial institutions, Goldman Sachs, JP Morgan, all of the large institutional sort of investment houses, what they tend to do. Now, this might sound very cynical of me, but they tend to anticipate the anticipation of retail level traders and investors. And what they will do is they will push, even though there was no rate cut, should have seen there was an initial spike up on the euro dollar, but now we're seeing a decline. Why is that? Because the market makers know that now the data is out. Nobody is looking for a because because of the no rate cuts. Nobody is really expecting the euro dollar to decline that much. They generally, like myself, are expecting a reversal on the euro dollar, and you will find some market manipulation or a little bit of price finding by these institutions. They will push the price down to a level that they want to buy at. So they will push the euro dollar down to maybe 109, 109.50, where I've got my buy limit at. This will have an effect on the DAX and other indices in Europe, which will push them further up, even though there's no rate cut. Now, what we will sort of find out in due course is that this buy limit is inevitably going to be hit because people are. It looks like this market manipulation that I've just mentioned is occurring. Now, let's see if it hits the limit at 109.50. Act. In fact, you can already see it reversing right now. Okay, this is a good way. What I'm doing here by putting this buy limit, if the euro dollar does come down to 109.50, it'll enable me to recover my equity that I'm losing on this trade twice as quickly if it hits the buy limit. But what I'm also going to do in order to keep this correlation trade running, weaker euro dollar, stronger DAX, so I'm going to enter again on the DAX with a sell trade. Now, I'm not quite sure if this is exactly the right time, but I mean, I would like to see the DAX hit 12,500. I'd like to see it hit 12,500 before I enter another short trade, another sell trade. But I think this is a head and shoulders formation. This is a head and shoulders pattern formation becoming very, very apparent to see shoulder, neck, head, neck, shoulder, and we should be able to see good opportunity to sell here. Exactly what I'm going to do. Now, if I'm wrong, and when Mario Draghi does his speech in just over 30 minutes, now these speeches can take a very, very long time. I mean, it can take an hour and a half, 2 hours, but generally he will make a few headline statements. Then there'll be a Q&A with reporters and reporters from Bloomberg and CNBC and other financial, Wall Street Journal, so on and so forth. And they will ask him, difficult questions that he will have to then address. Now, I think I'm hoping that before the monetary policy statement coming out of the ECB from Mario Draghi, that we're going to see the reversal that I'm hoping for. Now, the this is what your brokerage, or when you're first starting out in Forex, this is what they will teach you. They will teach you the easiest way to trade is to just wait for the data to come out when you're event trading. Okay, when you're doing live event trading, this is how this is how you react. Okay, so I mean, just read it. I mean, it's very very simple. It's a no-brainer kind of way of trading. It's for beginners, which is what I'm trying to point out for you. So usually, if the ECB is hawkish about inflationary outlook and they raise rates, it's positive or bullish for the euro, and vice versa. If they have a dovish or negative view on the European economy, and this they cut interest rates or they keep an ongoing interest rate, it's seen as negative or bearish. Okay, but like I said, they've been at 0% for a long time now, and even though it is not bullish, the fact that they haven't cut rates, they've held the rates at the same price. That doesn't mean it's necessarily bearish. Okay, it could have been a good idea for the ECB to cut rates in order to stimulate, um, in order to drive the euro down and to push the European indexes up. But that is not the case. They've just held, which is also not seen as bullish, as you've just read there. It's also seen as, it's not as bad as cutting rates, but holding a rate or keeping the ongoing interest rate is perceived as negative or bearish. But I reiterate, it's not as bad as if they had cut rates by 0.25% or 0.5%. So we're still seeing, the euro dollar sort of holding this price here. If it hits the buy limit, the DAX seems to have paused as well. Look on a 15-minute chart. Short term time frames. It looks almost certain. Got one candlestick down, third candlestick down. Another typical candlestick formation. Have three continuous lining candlesticks or Ichimoku candlesticks, Japanese candlesticks as they're known. You're generally looking at a further downtrend. And as you can see, the euro is declining, DAX is gaining. Can it go on forever? That's the question. And what will Mario Draghi say during his speech? I can't imagine he will say anything too positive because there is a very bearish outlook for the European economy in the whole and Germany. And now Donald Trump is looking at imposing tariffs on Germany, and what that means is then obviously that will affect the car and the auto industry in a very big way if he does that. Never mind the fact that Germany are already caught in the middle of this trade war between the US and China. So we're going to sit this out, see how we can manage the risk here, right? Generally, what I would do here, if I continue or if the market continues to carry on in this direction, if euro dollar continues to decline, DAX on the side effect will continue to rally off a weaker euro, then what I might consider doing, what I will do, put a buy stop in, right? Means if the price continues and hits this level at, I'm going to put it just above 12,450. Okay, so if it carries on there, at least I've got a bit of a semi hedge or a 50% hedge. So I've got two sells and one buy if it hits this level. So at least I've managed to control this risk, and I'm not going to close these trades until the DAX does start declining, because I'm very convinced that never mind what the euro is doing, the euro could continue on downwards, and we could also see a decline in the DAX. There is a correlation between the two. However, it's not 100% correlation. you can have a very negative statement coming out of the ECB in the next half an hour from Mario Draghi, and the euro will keep declining, and and uh, and the DAX will also decline just based on the bearish and dovish or negative outlook and whatever he says. And I can't imagine anything that he says to be extremely positive based on the PMI data that's coming out of Germany, the manufacturing data, the export data, and GDP, gross domestic product data that they've all been declining steadily, not majorly, but steadily declining into recessionary territory. And as I've mentioned, and as is being discussed very much on the news, Germany are in a technical recession currently. Technical recession meaning that purely based on the data points that I've just mentioned, that's what a technical recession means. So they're not in a full blown recession, but based on the data, it looks like they're heading into recessionary territory. Now we can see the DAX is turning around. So what I'm going to do, should I wait for this, what, 7 or 8 pips? I think I shall. There's no point in pushing, increasing my risk at this stage. I would rather wait for it to continue downwards to reach a better buy price. In fact, I might even move buy limit down to 109. What I may do, another buy limit, 109. By right clicking on the chart and putting buy limit, then see buy limit, buy orders, sell orders right here. But I like preciseness, so I'm going to put exactly. Set the price. So if it does continue declining, reach 109 and hope then for a reverse. This is a very, very major event. I can't stress that enough. This is a highly anticipated event. Many people were expecting the cut. We haven't seen that. We've seen a maintenance, maintaining ECB maintaining their interest rates at 0%, which previously mentioned is not bullish or it's not positive, but it's not as bad as if there were a cut. As I've mentioned before, this type of trading it's all about anticipation and risk management and knee-jerk reactions. Okay? And the market makers, those large financial institutions pushing asset prices down to a level where they want the level to be, where they want to buy. They want the euro go down to maybe 105, maybe 108, maybe 109. Who knows exactly where they've set their buy orders? They have buy orders just like I'm setting buy limits and buy orders myself. But they have they have the billions of dollars of liquidity in order to sell the euro against and buy the dollar, so essentially selling euro dollar to push the price down to where they want it to be in order to then start buying. They have the same amount of money and liquidity, those billions dollars, in order to manipulate the markets in such a way, or just to make they're market makers. So if they, you can imagine in the in the pits right now at New York Stock Exchange, or in the offices of Goldman Sachs or J.P. Morgan, that what are they doing? I mean, they're saying, okay, everybody was anticipating a rate cut, or for them to keep rates steady. So everybody's expecting euro dollar to go down. So this spike here was probably a little bit of manipulation there. They probably pushed the price up to hit people's stop losses. I don't like to use stop losses too much because of this, especially when event trading, when live event trading, stop losses. I mean, you have to give it your trade positions a lot of room to breathe, because you get these spikes like that. If I'd put my stop loss here, okay, then no, the trade instantly would have been knocked out. even though I manually exited the trades based on the fact that they maintained the rate at 0%, I can live with that. My decision. It's not me putting a stop loss 50 pips or 100 pips away, or even 30 or 40 pips away in this case, and market makers just hitting that stop loss and me getting knocked out of my positions and my trades. So I'm still very much convinced that we're not going to see major declines euro dollar today because no cut. So we're gonna hold tight for the next sort of 15-20 minutes, see how these trades play out. DAX trade, okay, chart. Hope this resistance level is for see much lower price on the DAX. Negative P&L around. Just have to remain patient. Let's see how. Now, you have to remember that we're in a very low interest rate environment globally. Okay, I mean the highest, as I mentioned at the very beginning of this video, this that U.S. Federal Rate Reserve, U.S. interest rate reserve is at 2.25%, 2.25%. They have room to cut, and Donald Trump, as I mentioned, is very much putting pressure. Federal Reserve and Jay Powell, the chairman, Fed, cut rates aggressively. I believe his latest tweet was, "What are these boneheads doing at the Fed?" He was quite rude about it, well, exactly the most polite person in the world, but he was very aggressive and very rude, and he said, "What are these bonehead economists doing at the Federal Reserve? They need to cut rates, by at least 0.5%." So have to bear that in mind. We've now had the data out, the ECB. It's out. Okay, we've still got some major events coming out now. CPIs, especially consumer price index. All right, so initial jobless claims. Past 2 weeks, they've declined. Like last week, it dropped. Week before, they gained, which initial jobless claims. That means people claiming benefits, right? So they're going to the DMV or wherever they go to in the United States to claim benefits, and they've been on the rise, which means that there's the unemployment rate is at 3.9%, 4% roughly, which is almost full employment in the United States. Can it remain that way for much longer? And what it's more about when it comes to unemployment rates and jobless claims is that it's about the quality of the jobs. I mean, it doesn't matter how many people are working at McDonald's. They're still not really uh, contributing that much to the economy, and their wages are very low. And no, this is what it's about now. From this point onwards, never mind non-farm payrolls and jobless claims and unemployment rates. It's about wage growth and the quality of the jobs being taken, being um, introduced, and being offered in the United States. So these are also very major data points that could turn this whole situation around very, very quickly, okay, in the next 15 minutes. Now, see where we are. Has buy limit been hit? Very, very close. We're only 8 pips or 9 pips away from it being hit. Imagine, almost guaranteed that is euro dollar continues to. At least I hope so. I actually want this buy limit to be. I can see a reversal. I might ask, I see a reversal coming. Have a look at relative strength in. Very nice indicator. Very nice indicator for assets. The way that it is used is when RSI reaches 70, means an asset is overbought. When it reaches 30, means it's oversold and it will start reversing, or it should start reversing. Now, where are we right now on RSI on a 15-minute chart? We're at 14. Okay, so it's extremely low. I don't think I'm even going to wait for this buy limit to get hit. I think I'm going to go straight in with a market execution, start buying. I'm going to delete buy limit right now. 109.50 buy limit. Delete that, and I'm going to go straight in. There has been a pretty big headline that's just come out actually from the US. Steve Mnuchin, Treasury Secretary, says that the Treasury, US Treasury, are seriously considering issuing a 50-year bond next year. Now, that's probably because of negative, the inverted yield curve and the yields that are being offered on 2-year and 10-year and 30-year bonds, okay, are decreasing by so much. And actually, 2-year bond is offering a higher yield when they invert. 2-year Treasury bond is offering a higher yield than a much longer term 10-year bond, which doesn't make any sense at all. It means that people see that over the next 10 years that there's there's a more chance of recession in the US and more chance of declines in the US economy than there is in the shorter term 2-year bond. So more people rush in and buy bonds, so the price of the bond goes up, but the yield goes down. Okay, and that's what was happening with the 10 years. Too many people rushed into 10-year bonds because they're considered a safer investment than the uh, than the 2-year bond, and the yields invert. You're getting a higher return now, or at least a similar, or almost exactly the same. It's around 1.5%, 1.65%, something like that. They're continually moving every day based on bond auctions, treasury auctions, and these treasury bills. It's another major issue and another major indicator of recession. When yield curves invert, so the 10-year and the 2-year yield version, yield curves invert, this has been an indicator for recession, a successful indicator of recession. Uh, let's say 70%, 80% accuracy rate. Seven out of the past 9 recessions have been successfully predicted and forecasted by inverted yield curves. So that's happened on a number of occasions over the past couple of months. So again, I go back to this global economic slowdown, this US-China trade war, Trump sort of looking at imposing tariffs on Europe and Germany especially. So you know we're in very very unpredictable times right now, especially when bond yields invert, and now we've just heard that Steve Mnuchin is looking at introducing a 50-year bond. It's never happened as far as I know. So anyway, we seem to have paused our trades here, market price action. As I've said, hourly charts. As you can see, the correlation between quite plain to see. Massive massive spike on the should hopefully start seeing based on very simple data called strength index. As you can see, as I go down uh, up, when I showed you the relative strength index earlier on a 15-minute chart, we're at around 16. Lowest it reached was as you move up time frames, you'll see that the lowest it reached on a 30-minute time frame, 30-minute chart time frame is 21. Okay, because it's calculated based on the parameters you set on relative strength index. Okay, so if you go into RSI, see that value of the RSI period is 14. Generally, no, you can change this. You can move it to 10, 5, which would give you much more extreme movements over shorter time periods. You're going to see, 70 being hit a lot more often. Just show you, for instance, if I was to move 5, see much more extreme movements because it's calculating the relative strength index over much shorter time periods, right? The industry standard tends to be sort of okay. As you can see less volatility. What I tend to do is not use shorter time frames like 5-minute charts, minute charts, even 1 hour. I tend to prefer using daily charts and 4-hour charts. I will go down and check 15-minute charts if I'm looking for a scalp or if I'm looking for a short-term trade. I like to use shorter-term time frames on charts. But generally, I'm a position trader. I like to look for trends. I prefer to use longer-term time frames. When event trading, it's difficult to see what's going on um, as much. But when you're looking at something like relative strength index, it's a good idea to use a either to adjust the properties or the RSI period. You could say you could go up to 20 day period. Okay, if you're on a day chart and you've got 20 or RSI properties time period, this is calculating relative strength index over 20 days. It could even go up to 50. But you see now that you're not getting a lot of, not getting anywhere really. Is it hitting 70 or 30? However, even if it gets close, 64, 65, you're looking at a much more longer term approach. Okay. So if I've got my time period on relative strength index at 50, I know that if it's approaching 70, it's much more likely the calculation has been done over a longer time period. It's probably going to give me stronger indication that there is going to be a decline, that this asset is overbought. As you can see here, absolutely correct in saying that. It hit 65 and it hasn't gone anywhere but down. Okay. That's what I mean by extending time periods, by using longer term chart time frames. Go back to MetaTrader 4 standard to stick to the norms and make things too much. 1 hour chart now on euro dollar. Like any major reversals coming, right at this precise instant, this precise moment in time. However, we are going to wait for the CPI results to come out, and obviously, I'm going to be listening to the to the Mario Draghi policy statement and Mario Draghi speech. Looking out for the headlines coming out on Berg, CNBC, textbook, other sources. Got a 5-minute countdown now on our economic calendar to the jobless claims, CPI data, and the monetary policy statement coming out of the ECB from Mr. Dragon Draghi, as he's known. So, like I said, I can't imagine Mr. Draghi saying anything too positive. However, there is a moderate to strong expectation that he could introduce some form of asset purchases or bond buying, or another way of putting it, money printing, quantitative easing. Now, if he does come out and say something as drastic, or take such drastic measures and say something along those lines, that he will start introducing quantitative easing in his last meeting at the ECB as the president, I again think it's extremely unlikely, just as I thought it was unlikely that they were going to cut rates. Okay, so we're down now, third 5 minutes. We're going to see these other data points coming out. See. Three minutes to go. Now, obviously, if we see very negative US data, we will probably see, or we should see, very strong reversals, euro dollar, and also the DAX. Bring up both charts here. See that both of my secondary trades have now turned into positive territory, so I am recovering some equity. I'm hoping for a much more aggressive and violent reversal on the DAX, which, based on the volume of my trade here. Now, the tick value on DAX, okay, is here at FIBO Group. Tick value on the DAX. If you right click in Market Watch, go into specification, and then see tick values, pip size, and all that sort of stuff. The tick size is 0.5. Okay, so it moves in steps of 0.5. Now the tick value is 12.5 per lot. Okay, but I've gone with 0.1, right? So it's a tenth of 12.5. So you're essentially looking at here, calculate it, on a lot, it's $2.50. Okay, gone. See, we're basically 20 pips in the money here. Okay, 20 points, I should say, because we're talking about indices and stock markets. You generally refer to them as points, not as pips. But we are roughly 20 points in the money, and you can see. Okay, so now we're sort of like 17. When we were at 400, we were 20 pips. We were at $50 in the money. So then you can very easily do the maths there. Every point is worth $2 cents. DAX. Same euro dollar. Now I know these tick values off by heart already. I mean, we when entering into these types of trades, you should always know the tick value, um, and how much every pip or every tick is worth when entering a trade, right? Euro dollar, you can see moving in sort of with calculated price. Every pip, a mini lot with 0 point volume. It's one. Every pip. See, we're 4 pips up now. We're $4 up. Okay, now the data's out. Yes, got positive data, guys. Over year, jobless claims are lower. Okay, this could mean two things: stronger dollar and the euro dollar continue to decline. The market makers will start pushing prices to where they want them, or they start selling like euro dollar DAX. That again is me, cynical trader who's been in the industry for many years, who understands that this is occurring on a basis. This occurs in event trading, which is generally why I tend to avoid these high volatility. I don't like trading them very much, to be honest with you, but they are they're market moves. The price action in these types of events can be extremely violent, and you can make a lot of money. So another data point just come out. Consumer price index actually worse than expected here, 1.7 over year. Jobless positive. We're looking mixed. Generally, average looking quite good. Consumer price index marginally, very much. Seeing good data come state. That doesn't work very well for us in this situation. The only way that it could work well for us is if Mario Draghi says something very positive about Eurozone, which is also extremely unlikely. However, just have to wait and see where the market is, and then of course we have to manage the risk. That's what Forex trading is all about. Even if you've got it wrong, the situation we have, you have to manage the risk in the best ways we possibly can. Now, the way we can do that by using buy orders, sell orders, yeah, based on data that came out. I'm going to start preparing hedges. Equity does suffer too. Sell stops on the euro dollar, like it will downward based on positive U out. But two sell stops, 109.33, only 20 pips away, current price. In the case that it does hit these sell stops, I will be fully hedged. I will stop losing any further equity on the. Okay, then the plan would be wait for the euro dollar to keep declining, make profit on these sells at a particular price where I feel comfortable to release them. Then I would start buying dollar back up again. That is if it which same with the DAX. Though we haven't got the headlines out from Draghi's speech yet. Buy stops. DAX. Well, also to fully hedge, we're going to have two active sell trades. About 60 points. 50 points away from current price. Which would mean roughly, if that happens, it's $2.50. Be another $250 loss. But if that price does, or these buy stops are hit, won't lose more. Worst case scenario. Okay. Some news on the Draghi speech. Headlines out. The only thing working for us in the US data was this decline. Consumer up. So
the interest rate in each operation will now be set at the level of the average rate applied in the Eurosystem's main refinancing operations over the life of the respective TLTRO.
As I said earlier,
for banks whose eligible net lending exceeds a benchmark,
traders hang on
the rate applied in TLTRO 3 operations will be lower and can be as low as the average interest rate on the deposit facility prevailing over the life of the operation. The maturity of the operations will be extended from 2 to 3 years. Fifth, in order to support the bank-based transmission of monetary policy, the Governing Council decided to introduce a two-tier system for reserve remuneration, in which part of banks' holdings of excess liquidity will be exempt from the negative deposit facility rate. Separate press releases with further details of the measures taken by the Governing Council will be published this afternoon at 3:30 p.m. The Governing Council reiterated the need for a highly accommodative stance of monetary policy for a prolonged period of time and continues to stand ready to adjust all of its instruments as appropriate to ensure that inflation moves towards its aim in a sustained manner, in line with its commitment to symmetry. Today's decisions were taken in response to the continued shortfall of inflation with respect to our aim. In fact, incoming information since the last Governing Council meeting indicates a more protracted weakness of the euro area economy, the persistence of prominent downside risks, and muted inflationary pressures. This is reflected in the new staff projections, which show a further downgrade of the inflation outlook. At the same time, robust employment growth and increase in wages continue to underpin the resilience of the euro area economy. With today's comprehensive package of monetary policy decisions, we are providing substantial monetary stimulus to ensure that financial conditions remain very favorable and support the euro area expansion, the ongoing build-up of domestic price pressures, and thus the sustained convergence of inflation to our medium-term inflation aim. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP increased by 0.2% quarter on quarter in the second quarter of 2019, following a rise.
So it's just very important to listening to speech like this, which is why I'm letting it play and letting you sort of view it, see how the markets react to Mario Draghi's every word. Okay.
The prevailing weakness of international trade in an environment of prolonged global uncertainties, which are particularly affecting the euro area manufacturing sector. At the same time, the services and construction sectors show ongoing resilience, and the euro area expansion is also supported by favorable financing conditions, further employment gains, and rising wages, the mildly expansionary euro area fiscal stance, and the ongoing, albeit somewhat slower, growth in global activity. This assessment is broadly reflected in the September 2019 ECB staff macroeconomic projections for the euro area. These projections foresee annual real GDP increasing by 1.1 in 2019, 1.2 in 2020, 1.4 in 2021. Compared with the June 2019 staff macroeconomic projections, the outlook for real GDP growth has been revised down for 2019 and 2020. The risks surrounding the euro area growth outlook remain tilted to the downside. These risks mainly pertain to the prolonged presence of uncertainties related to geopolitical factors, the rising threat of protectionism, and vulnerabilities in emerging markets. According to Eurostat's flash estimate, euro area annual HICP inflation was 1% in August 2019, unchanged from July. Lower energy inflation was offset by higher food inflation, while the rate of HICP inflation, excluding food and energy, was unchanged. On the basis of current futures prices for oil, headline inflation is likely to decline before rising again towards the end of the year. Measures of underlying inflation remained generally muted, and indicators of inflation expectations stand at low levels. While labor cost pressures strengthened and broadened amid high levels of capacity utilization and tightening labor markets, their pass-through to inflation is taking longer than previously anticipated. Over the medium.
As you can see now, the euro-dollar sell stops have been hit. So we're now fully hedged on euro-dollar. The DAX buy stops have not been hit yet. So what we can hope for now is that the fact that Mario Draghi and what we've just been listening to here is not extremely positive. Apart from GDP sort of a little bit positive about GDP, um, we could hope for a general sort of dovish negative outlook, and the markets reacting to that in bearish and negative way, seeing a decline. However, the euro dollar doesn't seem to be letting up. See this, and as I mentioned earlier, it's funny that what I mentioned earlier about knee-jerk reactions. See here, even FX Street said, um, yeah, euro dollar fades a knee-jerk bullish spike, plunges below 110 mark post ECB straight decision. So as you can see, when you're trading events, you do get these knee-jerk reactions, which is why I haven't used stop losses or take profit orders at this stage. I like to let, if I'm trading events, which I don't normally do. It's not my favorite way of trading. Like I said, I'm a position trader, but we have now reached or gone beyond this psychological mark of 110. We're now way below that, 70 pips below that. Okay, say way below. It's not a major decline, but it doesn't look like it's giving up anytime soon. So our best hope now really is to make money on the downside, to sell trades on the euro dollar. Hope the DAX doesn't react too much to the correlation between euro dollar and itself, and we will start seeing an oversold situation here. We are at 24 on the relative strength index. We are also at a very this could be considered a support level here. Though with such a major event, it's very likely that the euro dollar could continue to decline. You have to understand though, after years of trading these types of events, I mean, this is how I started when I first started trading. When I had my first trading account, I would only do event trading. I'd wait for non-farm payrolls. I'd wait for interest rates, unemployment rates, etc., etc. And you will find that once the movement, this type of movement, which is pretty big, from it's almost 130 pips. Once this type of movement has taken place, a lot of retail traders, a lot of people trading against the banks are going to jump on this trade. Okay, now even now they're going to start saying, okay, I want to sell, I want to sell, I want to sell, because of the news, because of the data. And the banks will realize this, and they will put a stop to it eventually. Eventually, the euro dollar will reverse. What goes down must come up in Forex. Similarly to the words of Isaac Newton, what goes up must come down. It's like gravity, but turned upside down. It's nothing continues, in a one-way direction forever. At least over the short term. Okay, so let's quickly go back and see if Mario Draghi has anything positive to say about the Eurozone or Germany. Okay, let's go back.
Governments with fiscal space should act in an effective and timely manner. In countries where public debt is high, governments need to pursue prudent policies that will create the conditions for automatic stabilizers to operate freely. All countries should reinforce their efforts to achieve a more growth-friendly composition of public finances. Likewise, the transparent and consistent implementation of the European Union's fiscal and economic governance framework over time and across countries remains essential to bolster the resilience of the euro area economy. Improving the functioning of economic and monetary union remains a priority. The Governing Council welcomes the ongoing work and urges further specific and decisive steps to complete the banking union and the capital markets union. And now we are at your disposal for questions.
Mr. Skolimowski.
Piotr Skolimowski.
Okay. So generally, after the main policy statement, he will be asked questions, many questions by different journalists, different establishments. Um, Once the policy statement is made, that's that really. It doesn't matter what questions they ask. There may be some very difficult questions for Draghi to answer right now, but essentially the policy statement is out. Um, what we are definitely seeing here is people jumping into the dollar, considered a safe haven, dollar treasuries and bonds, whatnot. We should probably see, Swiss franc or gold. Gold should probably be rallying right now as well, considering. No, no, I mean, sort of gold should be declining. Well, along with euro dollar, we can take gold and see where. No, it's not. It's doing the opposite. Based on all of the negativity and dovish outlooks and everything like that, looks like people are still looking at gold. To just because there's so much uncertainty, people don't know what to do in regards to interest rates. They want to get into safe haven assets: gold, Swiss franc, Japanese yen. Japanese yen. Let's have a look. Dollar yen. You can see the dollar yen has been strengthening against the dollar as well during these, even with the strong US data. That of course could continue in its uptrend once this sort of volatility because of this event is over. Now, I'm also still convinced and still positive that our trades will reverse at some stage. Difficult to tell exactly when, but you can see the sell stops here at 109.30 were hit. They're not in profit anymore. They're actually losing trades right now. Order the trades asset. Now, what we could hope for a reversal at this stage. That 110 psychological level mentioned earlier, it is a very strong level for euro dollar and has broken through it quite dramatically. But I don't think this is going to continue much longer. We have two options at this stage. We are fully hedged now. Two sells on euro dollar, two buys on euro dollar. Same with the DAX. Okay, it's two sells and two buys. So what I'm going to do is start releasing these hedges at some stage, and I feel it's right. Relative strength index is telling me that it's a good time, especially even on a daily time frame. RSI is at 67. Okay, now as I've mentioned before, it can go all the way up to 100, but 70 is the general indicator that it's overbought. Like here, here, yeah, when it hit 70, bam, way down till it reached down to 30. Happened 30, it was oversold. Start buying back down to 30. Sold. Where are we now? 70. So based on technical analysis, the fundamentals are out of the way now. Okay, the knee-jerk reactions are out of the way. All of that's done. So now traders are going to start looking. Now, this is generally how I trade. What I tend to do is wait for the events and all the volatility to be over and done with. The purpose of this video is to show you the just to show you event trading, to show you the risks of event trading, to show you the way that the market can be manipulated by market makers and how I like to trade them. It's generally wait for all of the noise to settle down, okay, and then wait for the reversals. Sometimes there aren't reversals. I mean, not for a day or two, but eventually there will be a reversal. So we're going to increase our risk. Okay, we're going to take another hit. These trades that are not making money right now. They were there to hedge us and to stop us from losing any more money, but they're not working for us. So let's take them out. the buys on the DAX and the sells on the euro dollar, and we're going to go in again heavy. See where it takes us. Now again, this was mainly done because of the relative strength index levels. Like I said, it's a very simple tool to use. 70 overbought, 30 oversold. Do see a slight support level here. Did hit this level here. I don't know what caused it. I can't remember exactly what day was it. 3rd of September. I can't off the top of my head remember exactly what drove the euro dollar down to this level on the 3rd of September. It just could have been a stronger dollar. Really, people are jumping into the dollar and treasury bonds. So that's that. And as you can see, we are seeing a bit of a recovery happening already. Euro dollar. Let's go into DAX and take a slightly shorter time size. High. You can see it's wiggling around there, starting to point downwards. Let's hope that carries on. Let's go Draghi, see if he's saying anything. He never says anything positive.
Almost all the things that you see in Europe, the creation of more than 11 million jobs over a short period of time, the recovery, the sustained growth for several quarters, were by and large produced by our monetary policy. There was very little else. Of course, there were structural reforms in some countries. So now it's high time, I think, for the fiscal policy to take charge. Second, there was a broad agreement on the parts concerning forward guidance and the rate cut and the reinvestment and the TLTRO. So you can see that that part was by and large agreed. And then there was, of course, more diversity of views, as it was vastly pre-announced by statements on all newspapers, wires, television, and so on. There was more diversity of views on APP. But then in the end, the consensus was so broad there was no need to take a vote. So the decision was, in the end, showed a very broad consensus. As I said, there was no need to take a vote. There was a clear, such.
What he's saying here really is that quantitative easing created many jobs since the Great Recession in 07 and 08, which is a form of monetary policy. Okay, but they are asking at the ECB actually. Now, monetary policy is a form of money printing, quantitative easing, and it's done very much by the central banks. Now, what they are begging for, what he's asking for here by saying fiscal policy, is he is begging the government to step in. He's saying that this is a government issue now. There's not much else we can do at the European Central Bank. We haven't got any tools left. We can cut rates. We can buy more bonds. We can issue more or print more money. But it's not. We don't know how much it's going to help. Okay. We're not quite sure at this stage how much it's going to slow down growth, how much it's going to stimulate growth in the economy. So he's asking for fiscal policy, which is the use of government revenue, taxes, essentially, to influence a currency's well-being and a country's economy. So he's asking for more fiscal policy as opposed to monetary policy, which is what the ECB or the European Central Bank are in control of. They control monetary policy, which is QE, interest rates, and so on and so forth. But fiscal policy is more of a government thing, okay?
Short run, but also in the long run, in designing action over the coming months. So the appropriateness of these instruments, because some think that the APP is appropriate only for risks of deflation. Others thought that the level of interest rates is already so low that it doesn't need action on the front on the APP. But the majority of the Governing Council believed that action was warranted. And so that was the chemistry, basically. Now, the limits. There was no appetite, frankly, to discuss the limits for one good reason, because we have a relevant headroom to go on for quite a long time at this rhythm without the need to raise the discussion about limits. I think I will stop here.
Ms. Weisbach?
Annette Weisbach, CNBC. Let me take your point on the length of the program and also how long you think those measures are needed, because I think one of the surprising elements of the proposed package was that the APP comes in with an unlimited amount of time, right? So what are you expecting? How long does this need to prevail in order to really get inflation back to target? And in your experience, how much effort does the central bank need to do in order to re-anchor inflation back at where you want to have it? And then another question is, did you discuss also to move the marginal lending rate into negative territory? And is that an option which could be a next step? And why didn't you do it, kind of enlarging the corridor now? Thank you.
Thank you. I mean, as far as the first question is concerned, we really think this package is adequate to re-anchor inflation expectations. And by the way, again, if I may repeat myself, if fiscal policy had been in place or would be put in place, the side effects of our monetary policy would be much less, the action of our decisions today would be much faster, and therefore the need to keep in place some of these measures would be less. So we believe this package to be adequate. Your other question was about whether we discussed. No, we didn't. We didn't discuss changing the marginal lending rates, no.
Mr. Sims?
Mr. Draghi, going into today's meeting, how many members early on in the meeting were actually against quantitative easing? And even though you didn't take a vote in the end. And did you also discuss higher amounts of monthly purchases before your final decision?
I'm sorry, the answer is that I can't tell you the numbers. We never did it, we're not going to do it. Just let you know that there was no need to take a vote, as I said, because there was such a significant majority. The second point is no, we didn't discuss it. There was no discussion about the type of assets, meaning that by and large it's going to be the same we purchased in the past. Now, with helicopter money, I got to be very cautious, because last time I was asked this, was about a year and a half ago. I said, well, maybe an interesting thing, but we haven't discussed. And immediately everybody said, oh, they are talking about this and studying. No, we are not talking. It's not been discussed. It's not an option that we considered.
Ms. Mastrobuoni?
Yes, Mr. President, you will forgive me if I read your tweet. It's from Donald Trump.
Yes, I've seen it.
Yeah, some minutes ago. He tweeted like, European Central Bank acting quickly cuts rates 10 basis points. They are trying and succeeding in depreciating the euro against a very strong dollar, it's all capital letters, hurting US exports. And the Fed sits and sits and sits. They get paid to borrow money while we are paying interest. So I would like you maybe to comment this. And second, you know that in Germany there is a very strong discussion about banks and negative rates on deposits and their intention to transfer these negative rates on retail clients. I wanted to know if you have an opinion on this, and so that's my two questions. Thank you.
Thank you. Now, the first question, I, in a sense, answered to the first question on the occasion of the first tweeter. And the answer is very simple. We have a mandate. We pursue price stability, and we don't target exchange rates, period. On negative rates, I think today I have said several times, negative rates have been a quite very, actually a very positive experience in terms of stimulating growth, sustaining inflation. But it's quite clear, and I did say this several times, that they have side effects, and they have negative side effects. And it's not so much that we want to protect bank profits. That's certainly not our mandate. But it's that we want to protect the smooth transmission of the lending channel. We should never forget that the European economy is a bank-based economy, that lending goes through banks. And we want to protect the transmission of our monetary policy through the lending channels. And I think that's the philosophy behind the tiering measures, the mitigating measures that we have discussed and approved today. Thank you.
Mr. Stumpf?
Hi, Mr. President. I would like to know the different options that the Eurosystem committees that were tasked to brought to the Governing Council. Thank you.
I'm sorry?
Which different options, I mean, besides the one adopted?
I think we don't discuss.
So, just to summarize everything here that's been discussed, I'm going to read from the Guardian newspaper. Okay, so European Central Bank has voted to, Donald Trump has been tweeting as per usual. He's lashing out at the ECB as they've launched a new stimulus package. Okay, a headline reads: European Central Bank has voted to restart its QE program, hit banks with deeper negative interest rates to make them lend. So, let me explain the difference between the refinancing rate, or the main interest rate. That's the interest rate that you're going to get from your bank. Now then there's a deposit rate, okay, which is just between banks. It's an overnight rate. It's the rate that the ECB will offer to financial institutions in order to park their money with the ECB, and this that they lowered it by 0.1% in order to encourage loans. Okay, so just we're going to sort of leave Mario Draghi's speech right now. I think he's pretty much done. But as you can see, the trades that we've got here are recovering. Okay, and just to summarize, that what goes up must come down, what goes down must come up. That is the general rule. We will see how much further the euro can recover and the DAX can recover next sort of the next few minutes. Okay, so Trump has just tweeted out, the ECB is weakening the euro against a very strong dollar, and this gives him even more reason to attack the Federal Reserve and to put more pressure on the Fed and Jay Powell, the chairman of the Fed, to do the same, to weaken the dollar in order to compete so that they can export more and the dollar is cheaper for foreign entities and foreign countries to buy US goods. So the new stimulus package from the ECB is going to be started, as I believe here, at it's gonna kick in November the 1st, as far as I can tell, and it will be 20 billion euros per month of asset purchases or money printing coming out of the ECB. So there you go. That's essentially what has happened today. So the main refinancing rates, or the normal sort of interest rate, the main interest rate has remained the same. deposit rate has been cut. So between banks, and this is a sort of interbank rate, as I've explained earlier, just between banks, to increase loans, lending of money from banks to individuals, corporations, and whatnot. They've dropped the interest rates by 0.1% there, and they're restarting QE. So I believe this is round 3 of QE3 or QE4. I'm not quite sure, but QE is back on the table. $20 billion or euros, I should say, per month, and they're also begging for fiscal policy to take charge. So they're also looking very much to the governments of Europe to start using taxpayers' money to boost and stimulate the European economy. So less monetary policy, even though they've just increased monetary policy by cutting the overnight deposit rate, and this deposit facility is extremely important because it affects swaps, and of course, us being swap hunter, we pay a lot of attention to the overnight rates, LIBOR rates, HICPs, which of course I can go into in much more detail in later videos and webinars to explain how those things work and how they affect overnight swaps. Let's hope these trades recover. We're gonna just leave it for a little while longer, and let's just see how they pan out. As you can see, we are seeing a slight reversal. It doesn't look too convincing, but from minus 500, we're now sort of only minus sort of 170. So let's give it a little while longer. Let's just see if Draghi has anything left to say that might affect these prices.
Any specific reaction planned should the U.S. intervene to weaken the dollar?
The answer to the first question is that we take our decisions really not with the idea of creating the kind of a ground for my successor, but we've taken our decisions, as I said at the beginning, on the basis of objective elements that have to do with a weakening of the economic outlook, a weakening that is more serious than expected, and with a revision in the inflation projections, and with the persistence of uncertainty. So these are the elements at the basis of our decisions today. Now, on the second question, we stick with the G20 consensus, namely that we will never pursue competitive devaluation. So we expect that all the G20 members would underwrite the same consensus.
Mr. Wiebe?
Yes, Mr. President. Thank you, Mr. President. I was quite surprised that a lot of economists who didn't talk that way and in the past are now changing their opinion and are questioning whether the side effects of the monetary policy, the negative side effects, will sometimes very soon be bigger than the benefits. So do you see any point in the future where this could happen?
I think that this concern is very well placed. I think we should be aware of the side effects of our policies, be there interest rates or asset purchases, and we are monitoring. We are closely monitoring the side effects. The Vice President, through its Financial Stability Action, is closely monitoring all these effects. So we are keenly aware. Now, to many of these side effects, the answer is not to change monetary policy, but rather implement specific macroprudential policies. But as I said, this is it's been a constant point of action, constant point of concern.
Ms. Boufaki?
Isabella Buffacchi from Sole 24 Ore. I have two questions. One is on one of the actions today on TLTROs, because there has been, I think, more than the market expected. They're longer, and there is not a 10 basis point on the top. And this is even before the TLTROs are in place. So is there a worry, preoccupation that loans are not really going to, especially SMEs? And then my second question is on this statement on effective and timely manner for government with fiscal space. Today, a very important think tank in Germany saw a recession on the horizon of Germany. And what is your view on the risk of recession? And do you think that a country should act before it has a recession rather than wait to have it to change the fiscal policy? Thank you.
Thank you. Well, when we approved, the first question is about TLTROs. When we approved the TLTROs, basically, if I remember correctly, there were two criteria. The first was to ensure that our monetary policy would be transmitted through the bank lending channel, and the second would be that those conditions would be dependent on the macroeconomic outlook, which has worsened since we approved the TLTROs, and therefore there has been an adjustment in the TLTROs conditions. The second point is about recession. We still think the probability of a recession for the euro area is small, but it's gone up. But still, we believe it's still a small probability.
What they're talking about right now are TLTROs, or TLTROs, targeted longer-term refinancing operations, TLTROs. European sort of Eurosystem operations that provide financing or loans or cheap money to credit institutions. By offering banks long-term funding at attractive conditions, so very low interest rates, sort of loans to institutional investment banks. So essentially, the purpose of it is to stimulate, it's favorable lending conditions for banks. And this is supposed to stimulate bank lending to the real economy, or small, medium, sort of size enterprises or SMEs. So today has been very, very interesting. Has been a very interesting ECB sort of meeting statement, and the data coming out of the ECB has been extremely interesting. Now, what we can sort of summarize, I think, from all of this is that, okay, so the main sort of refinancing interest rate has remained the same, which you saw had a knee-jerk reaction to the upside on euro dollar, which very quickly then got quashed, sent it, flying down to this sort of support level at 109.30. Likewise, the opposite happened on the DAX. You saw a knee-jerk reaction to the downside, then a massive rally to the upside. We've waited. We lost a little bit on the upside. I should have kept my initial trades, I suppose. I mean, let's have a look at what went wrong and what went right today. Okay, because we're just about to. I'm going to wrap this video up now. So what went wrong? I probably should have kept with my initial gut feeling and the general consensus that that they were not going to cut rates, which is a bearish thing for the euro, and that is what happened. But I thought, as it was so heavily anticipated that they were going to cut, and they didn't cut, they kept the rates the same, that it would be more bullish for the euro than it actually was. And we've seen the euro dollar decline off the back of that, even just holding the rates where they were. But what really brought the euro down was not actually the the mainstream rate, okay, not the general interest rate. It was the deposit rate, which is the between the banks. Okay, so that's this, right? Deposit rate was decreased by 0.1% today, and you can see from what I'm reading here, it's the interest rate paid on the surplus liquidity that credit institutions may deposit overnight in an account with a national central bank that is part of the euro system. Okay, so it's just between banks and financial institutions, and that affects swaps and LIBOR rates, and things like that. It doesn't affect the average Joe on the street. Okay, it doesn't affect your savings account. In other words, it's just between the banks. But it did cause the euro dollar to decline quite rapidly, and I suppose the fact that they didn't raise rates, which was definitely not on the cards at all. That was extremely low probability of that ever happening. It was either maintain or cut today in terms of probabilities. And then we had the and we did, I mean, if you remember at the beginning of the video, I had sell positions in based on the fact that those were the two possible outcomes. It was either maintaining or cutting. But I thought if they maintained the rates, that it would be slightly more bullish for the euro dollar than it was. I mean, we did see this bullish spike to the upside. Unfortunately, that didn't continue, and we ended up, sort of losing on the downside here. But we have done and managed the risk correctly. As you can see, we're now up. We lost around 120. Now we're roughly around where we started at the beginning of the session. Okay, so we were down 120, and now we're up by we're hovering around 185, $100. So we're pretty much where we started off. We haven't lost a lot, we haven't made a lot, but what I have demonstrated is that these types of events cause major volatility, and in order to get them right, you have to act extremely quickly. You need to have a plan A. My plan A was to go with the general consensus, which I would have been correct. I could have made a lot of money on the way down and then started buying, closed those sell trades, the initial trades I opened where we lost here. Lost on this $60 there, and another. These were the protection trades that we lost money on that didn't work for us, because I saw that the price was stalling here on the euro dollar. Price was stalling here on the upside on the DAX. I expect the DAX to continue declining because it has been generally, as I've mentioned, it's not looking good for Germany right now based on the latest data releases. So I would expect a downtrend to continue on the DAX. Now you can see it's continuing to come down. 400 now, 12,400. Euro dollars back up to 109.75. I would expect it to cross back over to that, or at least get to that 110 level. And we're actually in the money now on this whole event, based on mean reversion. Mean reversion is just a fancy way of saying trading a reversal. Okay, so when something becomes oversold, you then start buying at a particular level. If something's overbought, you then start selling it at a particular level, which was indicated quite clearly to us by relative strength index. Okay, so you can see relative strength index can be a very, very useful tool to use when trading markets. So I think we're going to do quite well out of this reversal. Actually, we're up around 450, 500. The reversal seems to be getting pretty hot right now. I'm going to lower my risk because I don't think it's going to last forever. We've come down from here to here, and we've had a 50% retracement. According to GAN theory, we should probably start seeing, I mean, that's as good as you can probably hope for on a live trading event with such volatility. So what I'm going to do is I'm going to close these trades, all of them. Okay, and now we're out. We're absolutely out. We've closed, and we're actually up on the day. You forget, or if you don't count these trades, these pound dollar and pound Swiss franc trades. Okay, if you ignore these trades, which I closed just before the event and the data was released, in order to have, you know, a clean sort of slate, which I shouldn't have done. I just didn't want to confuse, you know, the video. Okay, so if you delete this 270, let's call it 275. These were swap trades. Okay, I was trying to make swaps on these trades, which is what we do at Swap Hunter. But ignore these trades. So that's 500 to 556. Okay, 556. Delete that out of your mind or from this figure. 556 plus another 40. Let's say 600. Okay, so 585. And we just pay attention to these trades. Okay. And you can see that if we minus 580 from 255, we're left with around 200 and around 200 and second. Just calculate this. I can't top of my head. 585. 350. So we've made $350 from this event. Okay. Now that pretty much does it. I could say with all fairness that I believe I should probably have stayed with the general consensus of the market and kept my sell trade at the beginning and ignored this knee-jerk reaction. Kept the sell trade, made the money on the way down, made the money on euro dollar, and made the money on the way up on the DAX, which is what everybody was expecting. But now you see, you know, just there are many ways to manage the risk on these types of events, and trading the reversal or mean reversion is just one of them. And that's generally how I like to trade live events. So I don't think it's going to move much more sort of violently from this stage. So thank you for your attention, and I hope you've enjoyed the video. If you do have any questions, then you can most certainly get in touch with us at swaphunter.com, or just post some comments on YouTube comments section below. Do have a look at www.swaphunter or swap-hunter.com and go online, register, send us an email if you have any further questions about how we or any sort of upcoming events, any further training sessions, and also all of the sort of preferred brokers that we work with, and also the PAM account that we run with FIBO Group. So what I will do is leave it there, sign off, and thank you very much for watching.